Okay, can everybody hear me well enough? All right, so let's get started. I thought maybe we would start with you two, since we haven't heard from you, put you on the spot, and let you express your views.
So I think
Oh, yes.
my mic still, or sounds like I'm not. Go ahead. Go ahead. No, go ahead. Okay. So I'll just go ahead and use this. Am I good now? So a couple of things that I thought to comment on just the prospect of future production in these shale gas plays is the role of technology and working in the technology field. It is amazing the amount. The technology side of this, we really don't know what we're doing yet. There's a long way to go on the technology side, and I think the significant decrease in the projection of recoverable gas from these shales may turn around somewhat, not entirely, but may turn around somewhat with the technology side. If you look at the estimate of drillable locations, for instance, when I worked at Mobil, I worked in tight oil diatomite in California, and they started out at 5-acre spacing there, and they thought they're going to develop the field there. And then they went to 2.5-acre spacing, and then they went to 1.25-acre spacing, and now they're at 3/4-acre spacing. So I think that the prospect of infill and increase of well density, we can't tell what that's going to be in the first 10 years of the production or in the Haynesville, the first 5 years, right? And the Hugoton field, I just want to comment one thing about the Hugoton field. The numbers there are quite stark. So you've got 35 TCF over 70 years. I would wager that at the first 5 years of production coming out of the Hugoton, they didn't have a very good estimate of what that recovery was going to be. And if you look at the first 10 years, I guess it is, you were saying of the Barnett, we've got 11 TCF. Yeah. And a lot of that decline that's going on now is really people aren't drilling much in the Barnett anymore. So I think there's a lot of upside potential still. I would say the general tone of that, given the part that technology's got a long way to go in shale gas wells. And really the technology that's being used right now is not to optimize production, it's to reduce cost. That's the technology that companies are using. They're just trying to reduce cost. I think there's a lot of optimization that can happen yet, and I think it's not going to eliminate decline, right? But I think the current operations in there it's all about cost cutting. There's a lot of potential on the improved production side. So I think I'll stop there and let McCool add something.
So the overall thrust of the two presentations really was on what is the potential reserve in these basins, and I think the answer very clearly is we don't know. I don't think the gentlemen that presented know. I don't think the companies that invest in these know. I think what we do know is what we have produced so far, and what we've done so far is truly remarkable. I think if you were to ask somebody, if you had asked a group like ours 5 or 10 years ago what the reserves and what the production would have been, nobody would have predicted what we've just done in the last 5 years. Right? So I think to presume that we can predict what's going to happen in the next 20 years, let alone the next 5, is a real stretch. And there's 3 major uncertainties that we have. One is just understanding the resource base. I don't think we've begun to understand the resource base in many of these areas. I mean, you talk about the Bakken, you talk to Continental Resources, or you talk to somebody else, you'll get very wildly different assessments of the reserve base. Is the Middle Bakken the only producing member? There's claims of the Lower Bakken, and the Three Forks are going to be just as productive as the Middle Bakken. Right? The same thing with a lot of these other resource plays. I don't think we have a good idea of what the resource base is, and I think it's very dangerous to actually predict based on past history. We've been wrong doing that before, and I think we should be presumptive enough to say that we understand the resource base well enough to make these predictions for the future. I think it's good to be cautious, and so I agree with what you gentlemen were saying about, I think the media and perhaps some of the people that are selling their companies to stock analysts and so forth are overstating things. I think there is, perhaps that's a fair criticism of those people. But I think it's equally important to state that what has been achieved in the last 5 or 10 years is truly remarkable in terms of gas production, in terms of oil production. And I think that we should be cautious in our projections, but we shouldn't say that this is going to be sort of, the resource base is going to be this number, because we don't know the number, right? We can certainly, so technology, I think, is what John was mentioning. That's the second big uncertainty. There's a lot of things. We recovered about 5% of the oil in the Bakken in place. What's to say that we don't double that by applying technology, let alone the resource base, right? So resource base uncertainties, technology uncertainties, and of course economic uncertainties. The numbers that you were showing were technically recoverable reserves. And of course, the numbers that you see from past history are economically recoverable reserves. And they're very different, right? So you can't really compare technically recoverable reserves with economically recoverable reserves, which depend very much on price. Right? So I think there's a lot of uncertainty. I don't certainly presume to know. I'm a technologist, and that's what I work on. I certainly don't have a good feel for what the numbers are in terms of reserves. What I do know is that there's some remarkable achievements that we've had in the last 10 years, and I think there's going to be even more remarkable things happening in the next 5 or 10.
Okay. I would like to address this notion of the technology changes, because I've heard a lot about that from various speakers during the conference. And just to throw this out to get the dialogue going, I hear that we should be optimistic about technological changes, and yet I'm not hearing any specifics on what we can look forward to technologically that's going to make this bump up in production. So, you want to take that?
Well, I'll give you several examples. Okay. So I mentioned the case where in the Bakken, for example, we're getting 5% of the oil in place out. There's all kinds of technologies being tried out right now in terms of doing things that we've done in conventional reservoirs. For example, like injecting water in the ground, injecting gases in the ground that'll recover an incremental 5, maybe 10% of the oil in place. Okay. That's never been done in a tight rock like that. Okay. We don't know how to do it. But, well, you can double the production. I mean, you're basically doubling your recoverable oil in place. Right? So whether we can do that, I don't know. But the fact is that that is what technology holds out for us in the future. Right? We've talked about getting production up from existing wellbores and new wellbores. There's a whole host of technologies coming through in terms of both fluids being used in these fracks, the types of fracks being conducted. I mean, everybody right now does fracks in a particular sequence. They do 1, 2, 3, 4, 5, 6, and do 20 or 30. Nobody knows how many fracks are optimal. Do we do 30 of these? Do we do 20 of these? How far do these fracks go? All the measurements that we've made, for example, you create fractures that may be 600, 700 feet long, but you're only producing from about 100 foot of that frac. So that's 1/6 of the frac that you're creating is actually producing. If you were to double that, all of a sudden you get far more productive wells. And that is happening slowly. So I think those are two examples of things that we can do to really increase both the production as well as the reserve base.
If I could just kind of counter that, I got a mic on. It's just that if we look at technology, there are very big limits. And I'll just give 2 examples and kind of move the conversation back to natural gas. Gulf of Mexico gas production peaked in 1997 at a little over 14 BCF a day. It's now excuse me, at about 5 BCF a day and dropping fairly quickly. And the Gulf of Mexico has produced about 175 TCF in the last 40 or 50 years. And the Gulf of Mexico has also been probably the biggest laboratory for technology advancements of any part of the oil industry, and yet it's in terminal decline. And there's really, I think, no one who can make a case that you're going to find another 175 TCF. Sure, there may be gas underneath the salt well, but I had a long chat with McMoran Exploration, and sounds like virtually nobody has produced a single molecule of gas below the salt well so far in the Gulf of Mexico, and it doesn't sound, from my conversations with them and others, that this is going to happen within the next few months or maybe even years. So, there is a lot of gas out there, but finding it, recovering it is a very different story. And if we look at other things such as the coal bed methane industry, the San Juan Basin is now in terminal decline. The Powder River Basin is in terminal decline. These fields, the Powder River was less than 20 years old. The San Juan was really the first field that came on, and it's now the biggest. It's by far the biggest, CBM field in the world, and a lot of people felt that would be able to be reproduced elsewhere, and no one's ever come close. So I am somewhat skeptical that we will find that technology will move us forward. And one thing that I do know is that technology advances come in lumps, and I think we just had a big one by having multi-stage fracks into 20, 30 plus over 2-mile horizontals. I don't know what's going to move us to the next level, and it may be tomorrow, but it may be 10 years from now.
I would just like to comment just one thing about Gulf of Mexico and technology. I think a big part of the Gulf of Mexico technology side is finding the gas, okay? And that's a different, and once you find the gas, if you can get your wellbore to it, they have really high percentage recovery. Yeah. That's a totally different technology challenge than the onshore resource play, where we can find it and we know it's there, we just don't know how to get it out. And so I think I don't know what the prospect is, but it's a totally different technology story. Yeah. And the fact that we're so early in the game, I think, like, again, I would say, I can't predict the future, but I'm optimistic about the future. But I think from what McCool said, this early in the game, it's hard to tell. But it is a totally different part of the technology side. We're talking about recovering a higher percentage versus, in the Gulf of Mexico, finding it.
But then aren't we back to the notion of a manufacturing model? And I mean, it seems like we've seen quite a bit of evidence that shale plays have contracted down to a core. So I know in the Barnett, I live in the Barnett, I mean, you can have a well half a mile over here that is fantastic, and the well next to it might as well be a dry hole. So there doesn't seem to be a lot of homogeneity there. I'm a little bit out of my league here because my background is finance. But it seems to me like the manufacturing model that we had kind of moved beyond that notion. Have we not?
I think, just a quick comment. I mean, the manufacturing model is, I think, a factor of price. Everybody's out there trying to reduce cost, and reducing cost doesn't necessarily optimize the production, I would argue, but I don't know if you want to get in.
Well, just to maybe address some of the previous comments here. You guys are technology guys. I can certainly understand your point of view, and certainly shale gas and tight oil has totally been a technology play. I mean, there's been a huge lump of technology that's brought online. To think that that's going to keep on continuing at those sorts of growth rates, I think is, it's an act of faith. I mean, you're preaching to the converted, within your certain profession here. In regard to the Bakken, the graphs that I showed were Three Forks, the Sanish, and the Bakken itself. So that there's no other magical reservoir in the Bakken that's going to, add a lot of productivity, in my view. The total production, Bill alluded to some of this with the shale plays, but the total production in the Bakken right now is about 500 million cubic feet, or 500 million barrels, sorry. If you follow the peaking curve where you run out of locations at a little less than 12,000, the total recovery will be about 3 billion, which is the lowest level of the USGS technically recoverable estimate that came out a while ago. Continental Resources would beg to differ. They say there's 38,000 well locations in the Bakken. And I said, okay, well, if there's 38,000, how much oil do we recover? It works out to about 8.6 billion barrels. I think the continental resource estimate is 25. Well, I'm like Art. I like to look at the data. And the resources and reserves will be unknowable exactly until we recover the last barrel, right? So these are just estimates. What really counts for society is rate of supply. How fast can we convert that into supply? And if I look at, a play that I consider late middle age, like the Haynesville, you can look at the average IPs in 2008, 2009, 2010, 2011, 2012, and so forth, and you can see that they're declining. So we're drilling more wells with better technology, and the well quality is going down. So, I like to look at the data, rate of supply, rather than, totally just speculating on resources in the ground, which is what, politicians really like to do. I mean, it's a question of rate of supply, hugely important, and the net energy that you're actually getting out compared to the energy that you're investing. So those two parameters on top of resources are critical.
Okay. Okay, great. That's what I was just about. Do you want to make a comment, then we'll go to the audience?
I was just going to follow up on one thing Dave said. If we look at wells that are being drilled into lower quality rock, probably the best example is a company, Southwestern Energy. If you go out to their website, you go to their investor presentation, you can see they're drilling longer and longer laterals, and their IP, after 60 days of production, it continues to go down. They don't disclose how many fracs they put into these wells, but I'm guessing they're not drilling longer wells to put in fewer fracs. So if we look at it, from a frac by frac basis, it is getting worse and worse. And one of the things that any estimate I make, or the EIA or anybody else, it's very difficult to know what are the next 500 or 1,000 locations going to look like as far as quality of rock. And we're already seeing it. The lower the decline of the quality of the rock, no matter how many fracs you put into it, you're going to get a lower rate. So this is very telling to me that this is not just unique to the Fayetteville. This is happening elsewhere. So when well productivity is not, when comparing what you drilled this year versus last year, it's not necessarily apples to apples. So I think that's something that's very important to keep in mind.
Right. Why don't we go to the audience now? Oh, I'm supposed to pick. I'm sorry. How about you? I'll go to you, because I saw your hand go up first, and then I'll get to you.
I would like to suggest a scenario for you to discuss. Let's assume, for the sake of argument, because of the slowdown in drilling, that we see a decline in natural gas production in the U.S. from 2012 to 2013. And because of the decline in production, let's say natural gas prices in the fourth quarter next year are $6 to $8, between 6 and 8. Given that the decline rate from existing wells in late 2013 has got to be perhaps the highest we've ever seen in history, certainly higher than 10 years ago in late 2003. What's your outlook for the industry being able to offset that high underlying decline rate and to resume a multi-year growth rate in natural gas production?
Oh, come on, guys.
Let's go with these guys.
Well, I think one of the things that was clearly demonstrated by both the speakers was that you have very high decline rates in all these unconventionals, right? You have 60, 70, 80% decline rates in some cases. And so offsetting that requires a huge amount of drilling. And so if prices were to go up to $6 to $8, the expectation, of course, is that drilling would pick up and you'd get more wells drilled. In terms of projections, all the projections I've seen from the economic, from the investment banks and so forth, is that should prices go to $6 to $8, you'd barely be able to increase production from where it is now, right? So you're not going to get a big bump in production. You're going to get basically arresting those declines. And arresting those declines is non-trivial, right? So you're going to get some increase in gas production, but not a huge increase in gas production. And I think that with a 60% decline rate in these wells, you basically, you have to drill your way out of these declines. There's no other way. And so if you don't do that, which is what is happening now, you're going to see problems in terms of supply. And prices could easily go up. I think that was your point that you were making. These prices could go up in the next couple of years as a result of a slowdown in drilling. So I don't think you're going to see a huge increase in terms of production rates in gas. I think you're going to be able to arrest the decline. Depending on how much prices go up, you'll see some increase, but not huge.
As far as my thought on it would be, as far as what goes, is that if you look at what happened in Saskatchewan when in 2008 they were ramping up Bakken production, and obviously this is not shale gas, but this is I think probably the best analogy that we have seen and been able to document so far of what happens when all the rigs go home. And we saw that happen, and the Bakken production dropped from about 75,000 barrels a day of Bakken production in Saskatchewan to 35 or 40, and it's never recovered. And so, that's probably the best analogy we have, and there's nothing they can do now to really get anywhere close to where they were. And I think that that's something we are going to see, and we're seeing it happen in the Haynesville, because if you look at the Haynesville, and if a well recovers 3 BCF and it recovers 80% of all of its EUR in the first 2 years, which is what the researchers at LSU have found, it's almost impossible to, prices, you're almost insensitive to prices. You're just never going to be able to drill enough wells in a reasonable amount of time to get back to where you were. So I think it's, prices do get to a point where it just doesn't matter. And we've seen that in other plays. I mean, older plays, such as, some of the older oil fields where prices, they become insensitive, and that's eventually going to happen.
That I would disagree with. I think the declines would depend very much on price, and so I don't think you'd see a big increase in production in the rates of production, but you are going to be able to arrest declines should the prices go up.
I think that's you want.
If you look at the Haynesville, for example, the rig count's about 20 right now. It needs to be probably 70 or 80 in order to just hold the decline constant. And to grow production, you're going to have to go up from there. So you could be looking at quintupling the rig count at least before you start to see growth again. But you've already fallen 52% from peak. So it's going to take quite a long time to offset the declines that you've already had, even if you quintuple the rig count. So, the longer you wait, it's the more and more effort it takes to get back to where we are today.
But isn't that totally a price-dependent thing? I mean, the rigs go where the money is, right? I mean, all the rigs have moved from gas to oil because oil is where the money is. So it might take a while to get geared back up, but you could, like you said, you can arrest the decline or if you drill enough.
Yes.
But
I mean, not forever. I know it doesn't last forever, but just the beginning of it, it shows, number of wells has ramped the production up dramatically. Like it's incredible ramp up in the Barnett, for instance, over 10 years.
correct. I mean, if you go back and look at one of the slides I had, and you look at from 79 to 84, the price of gas went up 12-fold, and production went down almost 20%. I mean, that is I'm not saying that's going to happen here, but that is and that happened a similar phenomenon to not the same degree between 2001 and 2007. A huge ramp up in drilling and a 50% increase in price, but yet production went down. And that's something that I think has a non-zero chance of happening again. And I think that's something that very few, there's not necessarily a one-to-one connection between drilling and production.
Okay, this might be a good time to also segue into land use issues, because it seems to me that you can't drill into perpetuity. Yes, sir.
My question is kind of related to land use, actually. What is the plan and the yearly cost to maintain the abandoned and or capped wells after, say, 30 years or 100 years in the long term?
I think there is.
Well, I mean, there are regulations in various states for plugging and abandoning wells, and those have been historically around for a very long time. So Texas, for example, has laws in place to plug and abandon wells, and I think those regulations will take hold, and you basically have to abandon those wells in accordance with those regulations.
Just one addition to that, it's the same as with conventional wells. So, I mean, the plugging and abandoning procedure is going to be the same, the regulations are the same. And, you know, the well bores are the same for that, you know, that first several thousand feet and the surface casing and stuff. So it's if we hadn't been handling it in the past, if that's your perspective, then we'll probably do, you know, similarly poorly in the future. Or if we have been handling it well in the past, we'll be doing similarly well in the future. I don't see that it's not a fundamentally different thing just because they're shale gas wells. It's the same thing.
If I could interject something, one thing that I find interesting is on abandonment is, particularly when you get into urban drilling, if these wells are as short-lived as they appear to be based on the historical data, then you're talking about taking land out of potential future revenue generation. And that could be particularly significant in urban environments. And I think that's problematic. So, next question. Yes, sir.
I've found it interesting in the last few years to consider the issue of shale gas in particular for the perspective of electric utilities. And there have been a number of conferences at the University of Wisconsin sponsored by the Wisconsin Public Utilities Institute, which have brought together various leaders from electric utilities. And I found it really surprising. It's one thing that strikes me, first of all, is that utilities are very cautious by nature. They make long-term investments. So, you know, they're not the kind of people that are going to say 100-year supply, okay, we're all golden, let's just do our plants. My impression I've gotten from some of these leaders is that, from just speaking with them and hearing them, is that they are genuinely puzzled. But meanwhile, they are not building coal. They're basically not building anything, but counting on being able to build enough natural gas plants to meet demand if required. And in Wisconsin, in fact, we're shutting down a nuclear plant that is already bought and paid for years ago. It's being shut down. So to me, the unknowns here, it tends to indicate that they expect the supply to be there for a while. But they're also really puzzled about what to do.
I think the big uncertainty with the utilities, because they require these long-term contracts and supply for 20, 30 years, is what the regulations are going to do. And that's a big part of it in terms of ultimately the development of these resources is going to be very sensitive to what kind of limitations are placed on fracking and development of these wells. So I think that's one big uncertainty. And I think that the fact that a lot of the utilities are going to natural gas, as you suggest, is that there's some confidence that there's going to be a stable supply of natural gas in the coming years at a reasonable cost. I mean, that's the other really important thing. But I think more of that is not happening because of this uncertainty in policy issues. And of course, supply issues, as pointed out earlier.
Yeah, the capital cost of building a coal plant is about 3 times the cost of building a natural gas-fired plant, which is one of the things that's driving this. Also, in terms of fuel cost, you know, below 350 an MCF, you know, that's about the break-even point between coal and natural gas. If gas goes up to $7 or $8 again, it's going to be extremely painful for people in terms of the cost of electricity. But right now, it's a no-brainer. The EIA is telling us that, you know, gas prices are going to be low ad infinitum, and you know, that's also what's driving quite a bit of this gas build-out.
Yes, sir.
Kjell-Olof, we are allowed to make some comments, and I'm taking an international perspective for Europe, just to understand it's a completely different story there. The number of rigs operating with fracking in Europe is 1, and that is in Romania, and it's Halliburton. The number of wells we tried in Sweden was 3 non-successful. The rig in Romania has just been up in Ukraine and drilled 1 well there. Not too bad, but the price for it was $15 million to just drill 1 well in Ukraine. You know. The best basin for shale gas in Europe is beneath Paris. And I don't think that you will see 15,000 wells be drilled in Paris. So, I mean, when it comes to, I was on a conference in London just recently, and the conclusion was that shale gas in Europe will never come.
Yes, sir.
This came to mind when the second fellow was talking about technology, and one hears this all the time. But there are 2 factors, 2 forces that are occurring in opposition, and it's depletion and technology. Technology is hardly new. Probably the oil and gas industry is the oldest technologically advanced industry in the United States. So the difference between depletion and technology is reflected, I believe very strongly, in what we call energy return on investment. So you say the price goes up, so we spend more money to go get the next unit of oil or gas, but when the price goes up in dollars, it's also going up in energy, unequivocal. $1 is just a lien on energy. That's really how it works. And so everywhere we look, the energy return on investment for oil and gas, and once a field has been developed for even these new plays, is declining. So it doesn't matter how much technology you have if you can't afford it energetically, because at the very limit, when it takes you a barrel of oil to get a barrel of oil out of the ground, it doesn't matter that you have the technology. And that's the direction we're going into in every one of these places you're talking about, as far as I can tell. And if anybody has some more data for me, we'd love to analyze it as best we can.
Well, I think you're right. I think the energy efficiency does go down as the field matures. There's no question about that. What technology does is it helps improve that curve. That's all it does.
While we have some technology people here, there was almost no discussion about the ability of fracking and related technologies to improve recoveries for conventional oil fields. And I'd like to get some thoughts on what potential might be there and how that could affect calculations about conventional oil decline. So to give you an example, Matthew Simmons pointed out that the south part of Gawar has much lower permeability than the north part, and so that they're extracting oil from the north part because it's much easier to pump millions of barrels of oil out of it. Could it be that fracking technology improves the permeability? You could use it to improve the permeability of that or other conventional reservoirs significantly and change the productivity of those fields. And on the other side of it, as was mentioned about the Bakken, does fracking actually get in the way of techniques like water flooding a field, where in fact you just have a huge water cut as the water just goes through the frack rather than pushing or entraining hydrocarbons with it?
Well, I think we've been using fracking for conventional reservoirs for a long time. So that idea of using fracking, that's where it started, right? So we can improve recovery factors and production from conventional fields by significant percentage numbers. I mean, each field, of course, is different, by using fracking. And that's been done for 4 or 5 decades. We've improved those techniques, and we're certainly improving our performance in conventional fields as well. There's no question about that. Now, what you're saying about fracking getting in the way of oil recovery with water flooding, for example, is can be true if you don't understand all of the details of the subsurface. So for example, if you have early water breakthrough due to the frac being created, what you have to do is change the injection patterns in these fields. And over the last 20 years, 25 years ago, I used to run a JIP here on water injection into conventional reservoirs, and everybody in the room, all the operators would say, never frack your injectors. Today, that's exactly the opposite. Every single injector today is fractured. And that change came about in the 90s. Okay, that was, again, an example of technology being implemented. It was far more efficient to fracture the injectors and inject water. And I'll certainly go into details if needed, but today, almost every injector that we use in water flooding is fractured. So fracturing does not get in the way of improving recovery. The problem is that these reservoirs are so low in permeability that it's very difficult to actually get displacement from one well to the next. And so the question is, can you do this in some other way? And the answer is probably yes.
Yes, sir.
More questions?
Oh.
Sorry. He said he had long legs.
I was going to say, he's got
Deborah, this is for you. From a finance standpoint, if it costs $7 an MCF to produce gas, and we're only paying $2.50 for that gas, somebody else is paying the $4.50 through consumption of capital or stealing money from shareholders or investors or whatever. Where is the rest of that cost coming from? And how much more fun can those people afford?
Not much.
I mean, oh, go ahead. I'm sorry. No, I'm sorry.
I think it's very interesting when you look at, excuse me, I have asthma. When you look at BHP Billiton and their purchase of Chesapeake's Fayetteville assets, and then it wasn't even maybe 16, 17 months later, they had to write off over 50% of the purchase price of the assets. You saw it, we've seen massive impairment charges with BHP, Chesapeake, Exco, the list just went on and on and on. So it's pretty interesting, I think, who's been paying for this game. I'm not sure I answered your question very well, but yeah, so.
Well, I think the capital markets are now finally saying enough is enough. We're seeing, if we look at like Chesapeake as an example, I mean, they've taken out a bridge loan that they're going to have to repay. They're selling off other assets, and a lot of the smaller companies are just laid down rigs. And we're seeing like Exco as an example. They basically ceased drilling in the Haynesville. We've seen it in Canada basically slow down drilling massively because of this. And I think Randy Arisman is I think if he kept doing it, he was going to get fired. And so the capital markets, the shareholders are now waking up that the returns are not that we can't continue to outspend our cash flow ad infinitum. This is not sustainable, and so prices need to go back to where we can justify our investments. And this is I think basically many companies, the majority of them, I think have just drilled themselves to exhaustion, and now we're going to see it reverse.
Well, these companies. I personally think that shale gas should have started unraveling financially several years ago after the economic downturn. And I think that, frankly, the investment bank saw an opportunity to maximize fees. And they started pushing. In fact, we were discussing this last night at dinner. In my most cynical moments, which are pretty frequent, I actually think that the investment banks may have orchestrated this drive to low gas prices to some degree by enforcing or by pushing on the operators' production targets. They have overproduced, and that's what's driven the price to near record lows. Now, why would you do that? Well, if you're an investment bank, then it kind of makes sense. It's good business sense because you can put these larger independents, like Chesapeake, for example, into kind of a sticky situation, And then you can go out and you can do what investment bankers do. You can go take your comps and you can go to the client and you can say, essentially, have we got a deal for you? We think you need to pick up these assets. And that's exactly what they did. And the majors moved in and bought them. And then what happened? The majors got burned. They're taking huge impairment charges. And so I read there was a comment from an investment banker the other day. He said, yeah, we think we've got a little bit of JV fatigue right now. And I'm like, do you think? And so it's going to be interesting to me to see how they pursue this going forward. Because I think the bankers now recognize that no one's really interested in shale. And so are they going to keep pushing it to the investors? Let's see. We just have to wait and see. Because they've been the chief cheerleaders, and that's not my term. That came from Wood Mackenzie, but I think it's so true. The sell-side analysts have been the chief cheerleaders for shale gas plays since 2008. There's no doubt about it.
Is it a Ponzi scheme?
I never say that in public.
Over here.
Yes.
Having seen one of those investment banker presentations just the other day, one interesting comment that they made is that there definitely is JV fatigue, and a lot of these guys are getting burned, but it's not just the economics of the place. There's a couple. One is the landowners are getting more smarter about how. So you got these drilling commitments, and you have to have all these rigs going to drill up all this land. I can name half a dozen operators in the Eagle Ford play that are going to have to drop acres because they just can't drill it in time, which gets back to a people issue. They said that a lot of these big companies are like, well, I can't take on another shale plant. I don't have any drilling engineers. I can't manage 15 or 20 more rigs. And anybody at University of Texas in the petroleum engineering or geology departments knows how the students have fallen off over the last 15, 20 years. Apparently guys like me in their early 50s, below me there's apparently nobody until the guys in their 20s. There's a huge dearth of people, and that's another driving force.
Just real quick about the manpower issue. Enrollments have skyrocketed in the last 6 years. So we're up at, this department's like 600 students. We have about 30 undergrads per faculty member. And the oil companies are telling us more and more and more. But it is true, I think, very true, that a lot of these companies, each of these engineers is responsible for so much stuff that they just can't take on another project. So I think that's a huge impact on the cash flow and the production.
Okay, I've been given my marching orders. We're done. Thank you to the panelists and the presentations, and thank you.